This. Okay, so welcome to Chart Reading Mastery Session 2. And we did have to cancel last week because of the storm, as I was just saying. And so we're going to reschedule that. I don't want to get us behind, so we're going to do the session on Saturday, this Saturday. On, let's see what date that is. Check my quick calendar here. Saturday, the 12th of November, from 3 o'clock to about 4:30 or so Eastern Standard Time. That's New York time. So 3 o'clock p.m. Saturday afternoon, November 12th. Walter, you say the webmaster doesn't know. I hope he knows about Saturday. I'm not sure why you say that. He doesn't really have anything to do with getting into the seminar and stuff, or the webinar. Anyway, so tonight, what I want to do tonight is talk more about structure. We're going to go deeper into Wyckoff now and talk about waves. They're very important. So tonight, what I want to do is just review the trend line charts that people sent in. The assignment that I gave, the two charts from the British pound, the 4-hour British pound. I want to go through those in some detail because it's important that you know how to set up structure on your charts. So we'll look at those. And then also some class members sent in some of the charts that from markets that they trade. And laid out some trend lines on them, and most of those were really good. And so I want to review some of those and add a few comments, since I didn't get a chance to answer people individually because we were without internet for over a week, and then of course I'm swamped with all kinds of work the last few days. So I thought what I would do is just kind of highlight some constructive feedback tonight in the session, and I won't identify anybody's name or anything for on the charts because I don't want you to feel like you're under pressure or anything. Okay, Asta, that's good. He sees the turkeys out there. Then I want to talk about waves. We're going to talk in detail about these over the course of the remainder of the course. That's enough. Over the remainder of the course, but I want to show you what it's all about in terms of thinking in waves. It's a very important skill. And when you start to combine, I'll say this up front and I'll say this numerous times, when you can combine trend lines and waves together in your thinking, then you have something that very few traders have. And we'll see how that plays out. We'll talk about how to identify changes in trend through shortening of the thrust, a very important concept, one of the key concepts that we use in Wyckoff methodology. I'll show you a trade example on how that works, and then I'll show you a trade setup on the called the Shell Diver's Tragedy. It's a classic Wyckoff trade setup based on the wave structure in a market. And then we're going to start to move into price bars. I'm not going to go too deeply into price bars tonight. We're going to start those next time on Saturday. We'll talk more about price bars. But I want to talk about, since we're talking about shortening of the thrust, it's a good introduction to price bar analysis by looking at shortening of the thrust in price bars as well. So there's a couple of concepts, similar concepts, a couple of different applications. One, shortening of the thrust in waves, and two is shortening of the thrust in price bars. And then we'll talk about a Wyckoff concept. I never see this described anywhere else in the trading literature, at least in the material that I've read, and I haven't read everything. But that is absorption, and we'll talk about that tonight. And then we'll do a little bit about assignments, and then we'll move on to the next time we meet. So any questions on what we're going to do tonight? No questions. Good. Okay. Thank you, Hans. All right, so let's get into the British pound chart. Let me see if I can get a nice fancy. I'm going to use pink as a pen color here. Yeah, that's pretty good. All right, so let's just look at this and kind of go through this sort of step by step. This is the British pound. I sent you this chart, and it's a 4-hour chart, a 240-minute chart. It's not a bad one for the pound because it does compress the data pretty well, and it is kind of what a lot of the professional traders will use to kind of track the overall market in the currency trade. So if you're trading the Forex, you can look at a 4-hour chart as a way to kind of look at structure. It's very useful in terms of structure here. All right. So just starting over here at the left-hand side of the chart, we see some momentum come into the market here. We get a drive up where we have the range of the bar or the spread of the bar increase. We can see volume coming in on that. We put in a higher high at A, right? And then we pull back a little bit here to B. And notice that we can draw a small trend line, a horizontal trend line here at B. This would be the first thing that we would draw from the lows here and just straight across, and the market dips underneath. It's called a spring, which we'll talk about, I think, next week or soon anyway. But you can see that we're going to talk about absorption tonight, and here's kind of a modification of absorption. I know you don't know what absorption means yet, but when you come back and review this, you can think about this. Notice how we're not pulling back much. Here we pulled back quite a bit. Here we pulled back quite a bit. Now we have an impulse move to the upside. We have ease of movement coming up. And then look at the pullback. It's so small. That's strength in that market. That's strength coming into the market. Okay? And then the market rockets up here. And we can now draw our first diagonal trend line in off of this point, the low at B, and then the parallel. That would be our supply line gets drawn. I'm sorry, our demand line. Demand line gets drawn in first when we're moving up in an uptrend. And then the supply line gets drawn in second. Otherwise, we're talking about reverse use of trend lines, right? So the demand line gets drawn in first off of this low here and off of the low at B, and we put a parallel at the high of A. And notice how nicely, as we go up at C, it begins to get overbought. And it describes it very, very well, this trend line. All right? And we rally up here. Notice that we're not making it all the way up to our supply line. We talked about this earlier. You could draw a reverse use of trend line in here if you want to. Erase some of this so you can see clearer. You can do that. It's not real clean to draw it in, but you can do it. The important thing to note, though, is that supply is coming in earlier or demand is just tiring out earlier and it's not going all the way up. So we can expect some sort of a pullback, maybe even a reversal in the trend. Right? But think about, when you're analyzing this, we now have a nice run up. So just think about a pullback rather than a trend reversal. So we come down to D, and we can draw a horizontal here at D, or at this level here, and then a little bit later at D, the market dips down. We can trade that, when you make that trade, it doesn't produce much. And we get a reversal bar here, and so we don't want to hold on to that. Maybe that's just a scratch trade, okay? We do have, you'll hear about shortening the thrust in a little bit. We do have, and that's just another way of saying that the movement up is getting more and more pressure is coming in as the market's moving up. And that's what we're seeing here. So you might not want to take that. Plus, we've broken the uptrend channel, right? We've broken the demand line. Another reason why you might not want to take that. But we can still draw that line in, and we can see it there. And you know, if we're on a 4-hour chart and we're trading off of the 5-minute price bars or a tick chart or something like that, you might want to take that and be a nice little trade on an intraday basis, a short-term basis. In any event, we kind of test the high here and we fall down, right? Well, we can draw in another support line off of the levels of support that occurred here, the lows over here. Draw that in, we see that the market is holding here, and then it rallies up, but it puts in a lower high. As it comes down, we can now draw a parallel trend channel in, or I'm sorry, a trend channel and a parallel of that. We draw in the supply line first here at the top of this level at D, and then over here, and we put a parallel in at E, and notice how at F the market comes right down to it. We can also draw a horizontal where we had supply or resistance earlier that should now turn into support, right? We come down, it serves as support. We've got confluence here. Everybody see that? We rally up and we drive up through what was support and now still is support at E. We pop up and then start up again. Okay? Everybody see that? Anybody got questions on this section of this? And I'm going through this in some detail because I want you to see it all. And let me know if this is helpful to do it in this detail. Maybe not, but hopefully it is. Hans says, what do we want to see from drawing past or far back trend lines, like at ABC? This is an exercise, Hans, to learn how to draw proper trend lines. And that's what I'm trying to go through. I can't do it in a live chart, but I can show it to you on a static chart. And then you want to practice this both on static charts and on live charts. So the idea here is to just get some practice in this and to see where to draw these in. And you're going to adjust these as you go along. I'll show you some adjustments later as we go along, but there's nothing here that I would adjust at the moment. You might have put a trend line in here, for example, and in here. But then when that gets broken and we put in a lower high here, we would get rid of that and make the adjustment. But you're always going to be doing that. You're always going to be adjusting. With confluence, do I mean an area of support and resistance? Not necessarily, Lars. What I mean is there's two kinds of trend lines connecting together. Here we have a demand line on a downtrend channel on this red line here, and we also have a old resistance which should now turn into support line here, and that means it's confluence. It's kind of like a double shot of support here. Okay, and when we see that and we see a nice strong bar popping off of that, that's a buy point. In fact, all of these points are either buy or sell points. Not all of them, most of them are. So anyway, we rally up, we put in a higher high here. So we're looking to, create or extend a trend line, and you could do a trend line up like this if you want to. I didn't put that in, but you certainly can do that. We rally up, we come back down here, a nice clean trend channel down to G, and notice that we come right into what had been resistance, now turns into support. Okay. There's another buy point here. It rallies up. We can now put in the green trend channel, the demand line here from F to G, and put a parallel off at H, and it gives a nice clean level at which the market rallies to. Okay. So these trend channels not only give you entry points, or these trend lines not only give you entry points like here, but now it also gives you a target up in here to exit out of the trade. Okay? We go sideways a little bit. We break down here at I, and we start moving down. You can draw, I drew it in light red here, a trend channel in, and the demand line on that trend channel, you can see that demand is coming in earlier, so we would draw this dotted line here as a reverse use of trend line. It rallies up, but it fails at this resistance level here, reverses, comes down again, and then starts making lower lows. And we can draw a larger trend channel in at this point from this high here to K, and we make the parallel of that on J. So we have a nice downtrend channel, and you can see that it contains price pretty well. Here we have another level, another point of confluence where we've got resistance here, and the market comes up to both the downtrend channel, the supply line on the downtrend channel, and the horizontal resistance level. It's another sell point. We can sell the market short there. We would use reverse use of trend line here because demand is coming in a little earlier down here, and it down at M, it gives us a nice target to exit a short trade. Everybody see that? Anybody got any questions on this? I don't see any questions. So market rallies up. We can draw in, after we start creating movement up here, we can draw in from M and this small swing low here, a little bit higher up from M. We can draw an uptrend channel. You can see how nicely it contains price here. When we get up to N, market tries to go up a little higher and it fails. There's a little bit of resistance here. It rallies up, fails, comes back up, tests that resistance. You can draw another trend channel in here. We come down. There's some support that's created at O. We go up into here. We have kind of a almost like a triangle that comes into play here. But I don't even really look too much at apexes. I do, but not like some people do, I guess. And you can see that we have horizontal resistance here at P. Market comes down, we make a lower low. We're now in another downtrend here. On this time frame, we can draw in a supply line from N and P. It comes up at Q. And we have an access line here that runs from C to G to K and through N and P, and it comes back up here. So we've got confluence coming in here as well. We drop down, another lower low is made, we rally back up, we come in here, we're starting to stair step down. We've got support now becomes resistance, and so on and so on. Okay? Does the width of a trend channel mean anything? It's a good question. It gives you Walter, it gives you, the wider the trend channel, the bigger the trend. Let's put it that way. So for example, in this move down here, this move down completed over a couple of days, right? Maybe 1, 2, 3, 4, 5 days here. A week is what it took to get from this point to this point. And yet it's almost the whole month from here to here. And the market was swinging in this larger trend channel over the course of the month. So this was a shorter trend that ended earlier. This is a longer trend that's contained by the larger trend channel. So you can think about it that way. You can also do this with, you know, a larger time frame as well. If we looked at a bigger time frame then, and we looked at more data going back here, then we might have something that, you know, comes along like this, something like that, right? All right, Hans says, so for identifying trades that we are going to take, is that okay? Only see recent trend line channel. I understand the past horizontal support and resistance are so important. Assume the last bar in this chart is today's price. Is it enough to analyze the STU? I'd go back a little bit more, but you know, I don't know what's down below here. I'd want to make sure that, you know, is there another level of support down here that we'd want to pay attention to. You know, this is a 4-hour chart, and this is good if you're trading. If you're trading, you know, you want to use a higher time frame. You want to use multiple time frames here. So you want to use a little bit of a higher time frame for your overall structure, and then the smaller time frame to enter and exit trades and to manage trades. So that being said, then this is fine. If you're on a 5-minute chart, you know, and this is your overall structure, and you see this kind of oversold condition down here at U on a 5-minute chart, it's fine to be able to take that. Would I trade a daily off of a 4-hour chart? Absolutely not. I would want to look on a weekly chart and you know, which would, you know, I'd have more data for that, and because there's more powerful moves the larger the time frame. So I hope that makes sense, Hans. It is enough depending on your time frame, on your trading time frame. Okay? Let me know if you understand that or not, if you need more. Okay, good. Hans says he understands. So the idea here is to help you to see that classic trend lines help you identify the structure of the market. In each instance, they tell us what the market's doing. Is it going sideways, up, or down? It tells us a bit about the angle of ascent and whether it's, you know, here, for example, we're moving up pretty quickly compared to, say, this move here, right? We're moving up fairly fast. There's no breaks in between, so it's not a surprise that it gets oversold up here, okay? Where we're looking at this downtrend, this is a nice, well-behaved downtrend here, where these trend lines frame it out very nicely, and there's, as I say, there's about a month's worth of data in here. So at any point, we can come into the market and we can say, okay, we can read what's happening in this market, right? We can read pretty well what's happening in this market for this entire month. That doesn't mean that every time you step into a market, every time you open a chart, let's say, for example, I'm looking for a spot here. Well, if we walked into the market in here somewhere, it doesn't mean that there's a trade there, right? It doesn't mean that we can make trades that day very easily, maybe. But if we come into the market here on this day, or we've been scouting this market and we come in here or in here on this day, right? Or even if we drew a line in here and the market fell down and it's holding in here and we're in here, then our bias is going to be up here and it's going to be down here, right? And that's the way you use this. It doesn't mean that we walk into a market and we can immediately see what's. I mean, we should be able to see what's going on in the market, but it doesn't mean that we're going to be able to trade that market just because we have structure laid out. There are points, and I'll show you these points a little bit later in the course. There are points at which we want to look to make trades, and there are many points, many more points where we don't want to touch the market. Okay. So anyway, the lower neckline on the right below N, I'm not sure what a neckline is. Would you immediately take that as weakness? The lower neckline. I'm not sure what this here. Lars, is that what you're talking about? Higher. This purple line here, that's an access line. I'm sorry, I don't know neckline. I'm not sure what you mean by neckline. It's not something we talked about yet, I don't think. At least I don't remember talking about it. Do I see the hole below N as head and shoulders? Lars, I don't look for head and shoulders. I don't pay attention to that. You can if you want to. And if you look back on my blog into last summer, there was so-called head and shoulders. I remember this very well. There were several blog guys out there writing about head and shoulders and how the market's going to go down and so on and so forth. And I looked at the market and I said, no, I don't think it's going to go down. And I made that point. In fact, I posted this on the Money Show. There's an article on it as well there about head and shoulders. Patterns are not that helpful. What I'm trying to show you is market structure here, and then we're going to look at supply and demand. What I see here is not a head and shoulders pattern. What I see is a lower high up here, and compared to this last high, and on the shorter term, more lower highs and lower highs and lower lows. You know, once I see this, I'm trading in here, right? I'm not trying to find a head and shoulders pattern. They don't work all that particularly well. At least I haven't found them to do that. And I don't think about them. I don't really know them well. Schabacher was the first one to write about them. He's got the best descriptions of them. You can look there on that. But there are volume considerations and other things that go on in that, and you can't really see that here, because the low on the right is lower than the one on the left. The low on the right is lower than the one on the left. This is lower than this. Well, it's a lower low relative to this. I would agree. And you know, I would look at that and try to short on any kind of rally back up into resistance. And here we have a supply line and an access line to short against. And that's what I would do. Up here, you want to short up here? You could, but it's weaker than this trade here. You know, I'm not teaching head and shoulders, so I really can't. I don't use those. I don't think about those. Look, if you want to be like 99% of the other traders who are failing all the time, then I would encourage you to do what they do, and that's they're all looking at head and shoulders, and they're all using indicators, and they're all looking at the market in a certain way. What I'm showing you is some very classic, usable, workable, tried and true methods for trading. I can't help you when, you know, with what 95% of the other folks do, because they're all failing. All right, anyway, let's move on from that. One of the things I wanted to show you here is that when we have a nice trend line coming down here from N to P, and that picks up Q, and that's a nice trade to make. And we would put a parallel off of this low between P and Q, right? We'd start it maybe up here, and we could then drop it down to here. But notice the market is coming in a little bit. It drops down below that, makes a lower low. There's big ease of movement here, big acceleration down. It's not climactic for a variety of reasons, because it's just breaking down mainly through the lows here. So what we can do now to pick up R, to pick up this point, I would extend this down, I would extend this out, but I'd notice that the angle here has increased between this level and this level. So now I can use a reverse use of trend lines right here. At this point, I'll label it as 1 and this low here as 2. Do a reverse use of trend line, meaning I'm putting the demand line in first in a downtrend. And I'll make a parallel and put the supply line in. And at R, we have a nice confluence of several elements here. We have the reverse use of trend lines. We have the support that turns into resistance from this level 1 here. That's highlighted by the blue line. We have an uptrend channel that I put in light green that is showing overbought. And then I also have another horizontal resistance line right up here where the market peaks over the top of it and then starts coming down and comes down hard. So all of that is confluence. It's a perfect place to put on a trade. Okay? It's a choice point to put on a trade. Everybody see that? And once again, as we come down, the reverse use of trend lines give us a target. They tell us this is a good spot somewhere in here to exit the trade. And on it goes. All right. Any questions on this chart? Is it enough to lean on structure to take a trade? It's the first, Hans asked a good question. Is it enough to lean on structure to take a trade? If you're not leaning on structure, Hans, then your odds of winning on that trade drop dramatically. So that's the very first thing you want to be doing, is finding choice points in the structure to lean against when you take a trade. We're going to talk more about that, and next week we're going to talk about bars and what they mean, price bars and the volume. And we'll look at then combining these choice points in structure to lean against, along with the bars right around that area and the price bars and volume that lead up to that area, because both give us a clue. The price bars that lead up to the area will tell us whether the market's strong or weak and whether it's likely to break through that support or that resistance. The support or resistance point give us the trade location, and then the individual bars give us the trigger point, where we can pull the trigger on a trade and be relatively certain that we're hitting the last, the last gasp of that move before the market turns. All right. Reverse use of trend lines equals lengthening of the thrust. No, not necessarily. Reverse use of trend lines just means that the trend lines have reversed, or we're using trend lines in reverse of the way that we normally do. In a downtrend, we normally draw the supply line first. We did that at N and P to pick up Q, right? But here, the market starts breaking down through the demand line, so we would draw the demand line first, and then that gives us a point for the supply line. So it doesn't mean that the thrust is lengthening or shortening. It just means that we're using it in a different way. All right, so let's go to the second chart here of the British pound. I'll go through this a little bit more quickly because you can see what's going on just on your own by looking at the charts. But we've got a little bit of an uptrend here, a weak rally up to A. We have this horizontal resistance point. Because it is a weak rally, we can look to take a trade back down to the support level. The market starts to go down, it rallies up. We can draw in a trend channel here, putting in the supply line first, then doing a parallel for the demand line. Notice it gets oversold here at B, so if we are short, then if we are short from A or somewhere up in here, we want to exit out as we approach either the support line or as we get, certainly by the time we're oversold. Okay, we rally back up and then we hold on that support line after being oversold. This could be a place where you might want to take a trade. This would be some sort of a climactic action with testing going on, with structure in the background. We rally up, we get nice ease of movement. We have look at the difference between this reaction here, this pullback down to C, and this rally from B up to the high point here, where we put in a new high above A, right? Look at the difference. Here we have ease of movement, or acceleration, or impulse. Here we just have a correction coming back. And we know when that correction is over because we can draw in a trend channel and we can draw in a support line, and we have a little confluence that that occurs right in here. And it tests right in here. We often see that kind of testing of these support lines. We see it here and we see it here. Just some clues. We push up, more ease of movement. We go sideways. No pullback here. We push up, but notice that as we're pushing up, we're coming in, we're lower and lower compared to where we would expect it to come in. So we would use that reverse use of trend lines here. And here it's highlighting the shortening of the thrust, which we're going to talk about soon. Next here. We go into a sideways action here. There's between D and E and back up to F. We up thrust up here. We come down. We can draw another trend channel. It gets oversold here. We start moving up. We do the same thing all over again. Here we don't use reverse use of trend lines, but we're overbought up here. And then we go sideways. We get a horizontal level. It's it tries to peak above it. It fails. It tests it up here. Just like back here where I said we test support, well, we also test resistance as well. And we break down, we come here, we had support, now it turns into resistance, support, resistance, support, resistance, support, resistance, support, resistance, all the way down, all the way down. It's a classic stair-stepping kind of downtrend, which we want to try to take advantage of. When it does this, which it does fairly often. This is not just, unique. These are just, times, several months in the British pound. This occurs all the time. Now notice here that we started off with a trend line in the lighter red here. We drew in the supply line from this point to I, and then we put a parallel on here, right? But notice that the market never came up here. So supply is more eager, right? It's kind of like here supply is coming in or demand is growing tired. Here it's the same thing, but now we're in a downtrend. And so when we're coming down and we're breaking down through, we can draw this other line in, this darker. We would adjust, in other words, the angle of descent by our trend lines. And look at how nice it gives us locations, confluence all the way down, certainly from K and L and N. And there's a trade here in M as well. No real confluence there, but we've got nice setup. All the way down, and then it tells us when it's oversold and time to exit out the trades. So there you are for using trend lines in a proper way. And I hope that you can see, just by taking a market and marking it up with trend channels and support and resistance lines and reverse use of trend lines, I hope you can see that it really starts to frame in the market for you. It really gives you a market structure. Okay? It's the whole purpose of this. Most people are using indicators and looking for buy and sell signals, and you're going to get hurt doing that. Look, I'm giving you a way to look at the market in a fairly simple and straightforward way. Not necessarily easy to do this, but it's a fairly simple and straightforward way of just using basic trend lines, but using them properly. I see a lot of people use trend lines and they use them improperly, and I'm trying to show you how to use them properly. And you can see that you can take by being able to read the structure of the market and using the trend lines here, you can begin to take very good trades. Find good trade locations. Not everyone is going to work out, but you start to find some good trade locations. Okay, so let's do a couple of class member charts here, and you can see that this person, I would prune, by the way, some of these lines. I wouldn't have, like this right here, for example, this is, I wouldn't continue this out. This is, going out beyond this doesn't really help all that much. Maybe it turns into an axis line, but the market would have to come up and then come back down again, and you would see that. Okay, so I would prune this out. Some of these lines, I just wouldn't have, like this one here. After this point, or maybe this point, I'd prune this out. I wouldn't have this because it's making it too complicated to read. And this, same thing. I'd get rid of this line here. Use your basic lines, just your basic lines, to frame the market. But this is good. You can see that we've got the market here. We've got some shortening of the thrust coming in. It's picked up nicely by this reverse use of trend line. The market starts to put in higher highs here. Higher low comes in right at this point, right at our trend level, and we can draw in that uptrend and see how it holds in here very nicely. Same thing here. We're coming up pretty good, and then suddenly we drop down hard, We'll look at waves here. This wave is bigger than any of the up waves or the down waves so far. So this is change in behavior. And then we get, this little move here, and we start to come down, and we can draw that trend line, and bang, we got good locations for trades in here. Very nice, very nice. What I wanted to point out, though, is that we will see this stair-stepping all the time. And as I said last time we met, I'd certainly draw in the diagonals, but the horizontals are what I live for. And when you see a market rally up like this and put in a higher high and then come back and not much of a pullback here, and it sits on top of old resistance that now turns into support, it's a nice trade. Same thing here. We rally up nice, and it comes right back, sits on top of old resistance that turns into support. Okay? So keep that in mind. And same thing over here too. We're coming down and now we've got some resistance. So don't forget those. Those are really important. Here's another nice chart. Again, I would not look at every little, this level here, the odds are, it's so close to this level up here, the odds are they're going for this. Whatever this high is, they're going to go for it, right? But let's take a look at this a little bit more carefully. If we start to add the classic trend lines in, you can see we come down here. He had this blue line here. I'm assuming it's some sort of support. If you put in the diagonal trend lines, suddenly we've got confluence down there, right? And then we rally up. Notice here at B, we're going to talk about absorption at the end of the session tonight. Come back and look at this. Look at this sideways movement, just hanging here at a known support level, a known supply level. That's what we call absorption. And then the market pushes through and drives right through our supply line here, right? Beautiful, beautiful. And now we can look for a trade on the first pullback. And look at, we get this sideways movement where it goes nowhere, very similar to this. We're not seeing pullbacks like this. Now they're just going sideways. That's very strong stuff. Very strong stuff. Okay? We rally all the way up and it gets way overbought up here at D. And so we know that this is likely to have some sort of a corrective action. But look at what happens on F. Look at this. Bang, it comes right down. And it gives us a big move down, and it's sharp. And if we had volume in here, I'll bet the volume picks up down here, showing supply has come in. And we've also broken the demand line on this accelerated demand line, right? We rally up, we put in a lower high. Well, we can draw in a trend line here, a trend channel. But notice that it never comes back up to this. We start to get more steep in here. Again, we can use that support turning into resistance. Well, we break down through and then it comes up, and then trading that right in here. Very nice. And we can trade it down, and notice how our larger trend channel that we drew from this point and this point, and then at F put a parallel. Notice how nicely it frames it, and we have confluence of two different trend channels. This support line I wouldn't put too much faith in because there's hardly any support here. Okay, if it were drawn off of this, I'd like that. If it came, it doesn't come all the way down here, but if it did, then that's real confluence. I'd buy that in a heartbeat. But I wouldn't think about this so much as being support. We rally up, we make a nice move up, we have a little support level, and we can add that line in too. And yes, it does get oversold here. And notice that we have a trend channel going up, and we've got resistance right here. We're oversold in the trend channel at resistance. Oh boy, I like that for a short. Okay? So, nice chart, really good chart. And you can see, just taking your charts, how we can look at them and how we can frame them out with with just classic trend lines and trend channels and really make something out of them. Here's another chart of the S&Ps. This person's using candles, and you can see that they drew in a very nice downtrend line, good supply line and demand line. We get oversold down here. The market turns around. We get a rally up, and then we have a supply and demand line that continues on. Very well done here. I would add just a few things, and that is the horizontal support and resistance levels. We break down here, and this was support, now turns into resistance. My favorite trade. This is a great trade right here at A. Now, once the market starts to turn here, we can draw that supply line. We break down to a lower low. We come back up to B. Now we've got confluence between this horizontal support turning into resistance line and the supply line. Beautiful. Same thing here at C. It's the same story all over again, right? We rally up. We notice that we've got now here from both D and C, we've got two swing highs, and this market rallies up higher than that. We come back, we can draw horizontal support from this level over to here, and the market rallies up, and on this bar here it comes back and tests it. Very nice. Rallies up again. We can draw what had been resistance, should now be support. It holds here very nicely, then rockets up. We can draw that horizontal. Notice that even though we are overbought here, we work that off by going sideways. And if we drew a trend line in here, we would see that we are going sideways, just coming back onto this support level, this resistance level, which now should be support, which it does, which does occur, and we would expect to hold in here. It doesn't pull back. It doesn't start breaking down, right? We have, look, let me erase this. I want you to understand this carefully. Here we have, right here, we have the same thing that we have here, okay? Everybody see that? Let me know with a Y or a yes. We have the same kind of trading range in here, fairly tight trading range. Here, we have a trading range, and we have a trading range here, okay? Here, it breaks down and continues to go lower. We have a lower low. We break out of this trading range. Here, at H, it breaks down, picks up the demand line that we draw from E and F. It picks that up and starts to rally up from there. It doesn't continue to go down. Big difference here. Big difference. So what was overbought here in the trend channel gets worked off by going through the trading range. And then we rally up, and as this person did so beautifully here, put in a nice confluence point on our demand line, and on our what had been resistance now turns into support. So a nice chart. Okay, this is the kind of stuff you want to be trading. You don't want to be trading in the rest of the crap, really. I mean, where you can't really read the market. This person did. This is a tough one here because it's really kind of in a trading range, and we're overall big trading range. And this is one where, you know, maybe there's one trade here, and I wouldn't even take this as a trade. I mean, that's pretty much it. There's one trade on this chart, and it wasn't, and it's going kind of against this little uptrend that we have. But it's nicely done. It's nice that it's laid out well. Sometimes we just don't get, you know, a day in the market just doesn't give us a whole lot. There was one thing that I can see there. Here's again just a different day, different market. This is the Russell futures. Kind of the same thing that we were talking about before. Here we're in this sideways line here, sideways trading range. We break down through it. We come up, here's a trade. We break down through it. We come back, here's a trade. We break down through it even though we get oversold here. We come back up, confluence again, here's a trade, right? Now we come back down to this level. where the market's found some support, we come down, it rallies up and it tests in here. If you're a real aggressive trader, you can try to buy that if you want to. But I say, why do that? Why not wait until you've got now a higher high? You go sideways. I mean, this is the same stuff over and over again, right? Now we get good ease of movement coming up here. And now we just go sideways in a tight trading range. And we dip underneath and we push back up. Here's the trade of this move up here. Here's the trade of the day here. Here's the trade of the day here. Those are the two best trades on this chart. Okay? And look at what happens. It rallies up and does this. Look, just look at this. This is back a year ago in November 10th, 2010. We drive up, we hold, we push up, and we hold, and we push up. How is this here? We drive up off of the bottom, we hold, we push up, we hold, right? How different is it from this? We drive up, we hold, we push up, we hold. This is structure. These are great trades. You don't need anything more than this kind of stuff to be able to make a very nice living from trading. You don't need heads and shoulders. You don't need, fancy indicators. You don't need all the stuff that people are doing out there and that they're losing from. What I'm trying to help you to see is some clarity in how to read a chart and just going with what is pretty darn obvious. All right, everybody see that? Does this make sense to people? I mean, I probably am preaching a little bit. But, these charts, they're two different markets. This is the S&Ps. He's got here October 27th, 2011. So it's a year later, and it's the same bloody chart as what we're looking at here. Slightly different, but it's basically the same. Does this make sense to people? Is this helpful to you? I'm hoping so. It's a different way of looking at it. And I know I get on a bit of a soapbox, and I know I get down on people for, well, I sound like I get down. I'm not really trying to get down on you, but I want to impress on you, don't do what everybody else does, because everybody else is losing. Be smart about this. Do what works, and this stuff works. This stuff really works. But it's not fancy. It's not all kinds of glitz and, as Bill Wolf would say, chart jewelry, all kinds of indicators and stuff on your charts. And it's not to say that you can't use indicators. I use a very simple one on a couple of charts that I look at. You can do that, but you don't need them. And what I want you to understand is that you want to start to see this stuff for yourself. See things like impulse, 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 modest pullbacks, right? Points to take trades after the impulse and easy and modest pullbacks. Impulse, modest pullback. Impulse, holds. Impulse, holds. That's what I want you to see. Few people see this, but this is what I want you to see. Okay, I want to shift gears now. Any questions on these, on the trend lines and what we've looked at here before we get off of these? Okay, good. I'm glad it's clear. All right, now I'm going to shift into something that few people, if anybody, talks about, except for those of us who are in the Wyckoff tradition. Wyckoff said, always think in waves. Always think in waves. What does he mean by that? Here's a simple chart of the S&Ps a while ago, and you can see the market moves in waves here, right? I got green for up wave and red for down wave. And this is a way to look at the market. This is a nice way to look at the market. Okay, you can see that the markets move in waves. Now, Wyckoff said the most important thing to know about the market is the trend. Okay, it's the line of least resistance. And that's pretty straightforward. And the way we define a trend is higher highs and higher lows. Okay? But, Wyckoff said, you must always be on the lookout for a change in this immediate trend. And then he tells us how to find that, how to detect the change. He says this is how you detect it. In an uptrend, when the selling waves begin to increase in time and distance, or the buying waves shorten, either or both will be an indication of change in the immediate trend. Apply the same reasoning in a downtrend. So if you're in an up move, when the selling waves begin to increase in time and distance, or the buying waves shorten up, it indicates that there is a change in trend coming. Okay? Let's just take a look at this on the S&Ps here. You can see that here we've got waves are basically about the same. Up wave and down wave is about the same. Up wave, down wave about the same. Here the down wave increases a little bit, but immediately the up wave comes back into play. Right? Now as we start to come down, down waves are starting to lengthen here compared to the up waves. Right? Compared to the up waves. Now the down waves are lengthening, small up wave. Small up wave, remember what Wyckoff said, when the up waves start to shorten or the down waves lengthen and we've been moving up, then we're going to see this market start to change. Okay? Same thing here. So now here, clearly the down waves are in control. The sellers are in control. The down waves are larger. We got a pretty good up wave here, bigger than any up wave we've seen so far. That should tell us something. It should tell us that maybe there's a change coming. Right? Maybe buyers are stepping in here. But we still have another down. It doesn't mean that we can buy it immediately. Another down wave occurs. But then look at this big up wave, and then look at this small down wave. Bigger up wave, smaller down wave. And notice how things start to change. Okay? This is pretty crucial stuff. And we're going to go through this numerous times in the course. But we're going to talk about waves in terms of shortening of the thrust in the wave structure. Shortening of the thrust, or SOT, in the wave structure. Remember what Wyckoff said. In an uptrend, when the buying waves start to shorten, let me change color here. We'll do blue, I guess. Okay. Nice buy wave, right? Nice buy wave, nice and long. What happens? Buy wave shortens. Buy wave shortens, right? We're seeing shortening of the thrust. Then what we want to see is the down wave lengthen, get bigger than anything that we've seen before, and then look for the first pullback and short that thing. Okay? So let's take a look a little more carefully here. Here's a stock way back when, Agilent Technologies. You can see that this market's moving up. And one way to help with identifying shortening of the thrust is to use this kind of a graphic. It's just a straight up line, and then at each wave height, should be here actually, or I'm sorry, up here, we put a little crosshatch. And so from this high to this high is right here, and that is the same as here. Okay? But now look what happens. We rally from this point to this point, and that's B, and look, that's this distance here. Let me change the colors so this is clear. Maybe brown. So here we have this distance. Suddenly it shortens. The thrust is shortening. And now we go from this point to this point, and we only have this distance here. This is shortening of the thrust. Everybody see that? Everybody understand this? We're moving up, still making highs here, but this is starting to arch over. It's starting to mushroom over. And if we draw this little graphic on the side and just measure the waves going up, we can see that the up waves are shortening in distance. Okay? Look at what happens. Here's where we were at A, B, and C on this. And this is what happened. This is the 2008 fall. Okay? I'm not suggesting that every shortening of the thrust is going to produce this kind of big move like this. But it indicates that we are likely seeing a change in trend. Okay? And that's what's helpful about this. Okay. Here's Ford Motor Company on a daily chart. Here we have, let me go through this so it's nice and clear for everybody. Here we have a nice move up to A, and that's a good move. Here we go up to B, that's pretty good too, but not, you know, no, if this was our last rally up here, it's starting to shorten. And then we come to C, we can put that in, and D and E, and sometimes it gets, you know, there's not much here, but look at what happens by the time we get to F. Right? We go sideways here in this little trading range. We come up to F. We'll talk about up thrusts in a couple of weeks, but this is an up thrust. And by definition, there's shortening of the thrust in an up thrust. But we see this progressive shortening of the thrust. And then this nice big bar here, and we're off to the races to the downside. Okay? Here's a S&P E-mini on a 30-minute basis. Lovely here. Well, let's go through this, and let me just show you how to think about this when you're trading. Here's the day here. We're coming into this day, and we've had a nice run up yesterday. Well, 2 days ago, we have a nice run up, and it goes to this point, and then yesterday we come up here, and all the way here's yesterday's, well, yeah, here's yesterday's high up here. And now we come in, and look at what happens. We start to come down here, and notice how volume is sustained on the down move, right? Volume comes into the downside. We have now made a lower low. We have shortening of the thrust. We have a lower low. We rally up. This is a 30-minute chart, and look at the volume. There's nothing there. Right? And we can look on a 5-minute chart to short in here. This is the point to short. This is the best trade to make on the short side in this chart. Can you do this if you want to? Yeah, you could. But this is a much safer, much better short. I had a question come in, and I'm going to write this up probably over the weekend, and I'll send it out to people. But the question was about telling a story to set up a trade. And it's not just about support and resistance, but it's saying that here's the story of this chart. Number one, we have supply coming into this market. We've broken down here out of this trading range, and we come in and there's supply. Okay? We rally back up, but we have shortening of the thrust in the supply area, in the same area that we saw over here. Right? On a reaction, we see an increase in volume. We also see the wave structure lengthen to the downside. Let me put that in for you so you see it. I'll do it in red. Here we have a down wave. Here we have a down wave. And I'll just put the green up waves in. Oh, sorry about that. Up wave, up wave, up wave. Down wave, down wave. Suddenly, down waves increase. When I'm doing this, it's changing the thing for me. And the up waves decrease. Right? So we have shortening of the thrust. We have supply. We have new, fresh supply. We have a weak rally. Weak rally. And we have a change of behavior because the down waves have gotten larger. Okay? That's a story against which you can take a trade. Right here. That's a story of market structure against which you can lean and take a trade. It's not just about support and resistance, it's about combining all of these things to find a trade and then take the trade. Okay? It's kind of confusing when I get a higher volume on a lower low, but where the close on the last low is the high is with 2 in the picture. Yeah, we're going to go through this. There's some demand coming in, no question. It could be interpreted as strength coming in. Yeah, unfortunately, there are some folks who will say that, strength comes in on down bars, and high volume down bars is strong. Maybe. They don't really say that, but that's how it gets interpreted. It's not really true. You have to look at the whole thing here, the whole background. And we see supply coming in here. We'll talk more about that as we go along. All right, shortening of the thrust can also occur in the opposite direction. When we're coming down, we have down wave, nice and long. Down wave, nice and long. Suddenly they shorten. Okay? And then we're looking for the up wave to lengthen. So here we have it. Here we go. You can see we come down to A. We rally up. We come down to B. We kind of rally. We come down to C here. And you can see that the down waves are shortening. And then we rally up. We put in a new high. We come back and we hold in here. So anywhere in here is a good spot to take a trade, in my book. In fact, what happens, we see that the market, I didn't put the structure in, but if we look at this, let's just do this so you're clear. So we rally up. We put in a new high. So we have a higher high. Up wave, down wave, support. What had been resistance turns into support. Okay? This is using the wave structure. Down wave, down wave. Certainly this up wave is bigger than any of these down waves here. Okay? And even this down wave doesn't increase. And then we sit on top of support. And we see the volume pick up as we go up. It's very nice. That's demand coming in. That's where we want to look for a trade, right in here. That's the choice point on this chart. It's not down here. You could do a trade here, yes. Certainly you could do a trade here. The best one, the safest one, right here. Okay, so here's shortening the thrust on the downside. Same idea with that graphic, and this was the lows in 2009 or 2009. You can see that everybody was so worried about the banks failing and everything else, but we could read that there was shortening of the thrust here. Okay, and the wave structure was about to change. Let's go back one. Uh-oh. There we go. The wave structure changes here, where we drive up, and we've made a bigger up wave than the last down wave. Okay, and then we go sideways, we push up. You can draw on your trend lines. We get oversold, a nice buy point. We rally up, we go sideways. All about what we've talked about tonight. Okay, here's one on a 5-minute basis. Ignore all of this stuff. We come down. I didn't draw a graphic in here, but you could do that. We have shortening of the thrust in here as we come down. Okay. Aggressive traders on an intraday basis could buy this in here, or maybe buy this in here. Right? But we see it on all time frames in all markets. Okay. Let's look at this as a way to identify a trade. Okay. Let me ask you, what do you see in here? Here we are, we're coming in to this day in here, and we're on a 5-minute SPY chart, SPY, that's the ETF for the S&Ps. What do we see here? What do you all see? Well, first of all, we're at a point where we want to make a trade. Do we want to make a trade to the long side or the short side? Let's get everybody's opinion before we start here. Are we going to go long or are we going to go short? We've got a long, we've got a short, another short, gap up opening, let's go long. Anybody else want to make an opinion here? We got long, okay. Why do we want to go long here? And Trevor says shortening of the thrust just to the left here. That's right. You can see this market's arching over. We rally to here, we make this kind of progress, we make even less progress here. Everybody see that? If we drew that graphic in, it would look something like that. So we have shortening of the thrust here. Let's take a little bit, so there's a little bit of a change in behavior. We have down waves here. Let's put those in red. We have down wave here, we have a down wave here, we have a down wave here. And we were talking about up waves, and up waves, and up wave got small here. What about that down wave? It's increasing. Remember, when in an uptrend, when the up waves shorten or the down waves increase. Well, here we have up waves shortening and the down waves increasing. So here we have shortening of the thrust. We see that here on each of these points. That's right here. So we have the shortening of the thrust. Good observation, Trevor. Notice next, we have a support point here, right? and the market drives down through it, and it does so on an increase in volume. One thing and one thing only does that, and that is sellers adding supply to the market does that. Okay? It tries to come back up. Look at the low volume, trying to get back up above that. What had been support fails, now becomes resistance. There's no oomph behind this. There's no volume behind it. We come down, look at the supply coming in here, and we make a lower low. So now look at the rally coming up. Is it similar to this rally here? No. It's really choppy going up. And look at the volume. Here we had volume coming in nice. Here, there's no volume. Right? Look at how now we pair the wave structure here. Up wave, up wave, up waves shorten. Down wave, down wave, down waves lengthen. Support comes in. We produce that lower low on an increase in volume, means supply. Now we come back up, and we're right back up to where support should now turn into be resistance. We see it stall, and the market starts to go here. This is where we take the trade. This is the best trade of this chart. Okay? And that was right here on this first arrow. When we start coming down, you can add to it if you want on the breakout. We will do that from time to time. We can draw in a trend line here. We see it gets oversold. And if we look to the left, this is yesterday's high. We're coming back down to at least test yesterday's high. Here's where we exit that trade. We get in here, we get out here. You don't see the lower low. The lower low, Walter, we have a low here, we have a low here, and a weak rally, and we have a low here. It's making lower lows coming down. So that's how we use this, okay? That's how we use this. Make sense to everybody? And yes, there is a change in behavior. Absolutely right. Change in behavior as well, Trevor. Good observations. Everybody see this? This is also telling the story, putting together a variety of things that all say weakness. And we're using the waves, we're using trend lines, we're using support and resistance. We're looking now, we're starting to introduce the idea of volume. You'll see more about that as we go along. Look, very similar to what we talked about earlier. Here we have an up wave. Now it just broke out with a gap. So what? Walter says that it just broke out with a gap. So what? It's weak in here. You know, I didn't change the market. So what that it gapped? Gaps often are weakness, showing weakness. Just because it gaps, it doesn't mean it's strength. You guys got to get away from this idea that we have a gap, therefore it's strong, or we have a head and shoulders, therefore it's weak, or we have three raging crows on a candlestick pattern, therefore it's got to do something. This is the way that 95% of all traders think, and this is the wrong way to think. Gaps have nothing to do with anything. What you want to assess is the supply and the demand relationships in the market. And the way we do it is with trend lines, support and resistance, volume and price bars, which we haven't really talked about yet, but we will, and the wave structure. This is looking at the structure of the market. What I'm telling you is, what I'm trying to convey to you is stuff most people don't understand, most people don't get. And it broke out with a gap and it's a new high. So what? It doesn't matter. All right, let's take a look at, Walter, I just encourage you to have an open mind and not be closed down because there's a gap or some. What you're committing is the psychological, it's a cognitive bias, it's a cognitive heuristic, and it's called salience. You see the gap and you think it's important because it's so, obvious. This is gapped up probably because people wanted to come in and sell it, and they wanted to get good prices before they sold it down. And they bring it up. It happens all the time. Strong players do this, and they do it all the time. And they do this obvious thing because they know that salience is a big thing for traders, and they see that, and everybody will jump on it and say it's a gap, let's buy it, and buy it for all we're worth. And then they get killed. You have to be able to read the structure of the market. Look, up wave. So good. So, we're starting off in the morning here. It's 9:30 in the morning. This is the first bar of the day. We rally up. We put in a higher high over whatever this low high. Forget about whatever happened overnight. Just look at this. We rally up. Then we come down. Down wave bigger than up wave. We put in our support line. We come back up to resistance. Volume dries up on the rally. There's a trade right there. Okay. We drop down. We come back up. Aggressive traders could try to make a trade in here. Better, however, we make a nice up wave. We come down. Look at the up wave comes in with good volume. And so that means that there is a good, strong demand here. And it's rallying. It doesn't quite make a new high, but that's okay. We've got a small down wave. We can buy in here. We rally up. Boy, haven't we seen this before tonight? We come back in and it holds. We can buy there. 3 very nice trades. 1, 2, 3. All based on the wave structure of the chart. Okay? Here we look at waves on the current chart here. We have, we're rallying up nicely. Suddenly the up waves shorten, don't they? And the down waves now start to lengthen over here. We get a large down wave, and it still looks like this wants to go south, but we don't get big down waves coming in here. They've shortened. We've gotten a larger up wave, and there was a place to take a trade. Okay. Now it looks, by the way, that I think it went up a little bit higher, but now it comes down today, so it looks like it's failing here. It may come back down to test in here before it tries to go higher. Who knows what exactly it's going to do? It's nothing is 100%, but anyway, here's a setup that is known as the shell diver's tragedy. This is a neat little thing. And it comes about by Bob Evans. Robert Evans was the owner of Wyckoff Associates for many years, and he did a lot with the course. He added a lot to it. And one of the things that he did was he tried to explain market action, important market action, with little stories so that the average guy or woman could understand them well. And this was called the shell diver's tragedy. if you've gone down to the Caribbean or any of the islands, you'll often see kids, dive down for quarters, right? Or you'll in maybe not so much today, but a few decades ago, people would actually make their living by getting a snorkel, instead of an air tank, but going along, diving down, getting an abalone shell or some important shell, and then bringing it back up to the surface. So that's the idea here. And you can see certainly we get some impulse coming up. And so a shell diver would have his basket, right, float on a float, and he would dive down here, pick up a shell, and bring it back up and drop it into his basket, right? Put that shell in his basket. And he dived, catch his breath, he dived down, pick up a shell, come back up to the surface, stick it in his basket. This guy's doing pretty well, right? Dives down, gets a shell, comes back up, puts it in his basket. And on he goes. And this guy's going to make some good chunk of change, right? Now, however, he dives down, and now this time it's much deeper than the previous dives. And he sees the shell down here, and he goes down for it, but he's gone down now so deep that as he comes back up, he's run out of time. He's run out of time, and he doesn't have any air, and he drowns because his basket is way up in here. And as he drowns, he goes down to the bottom, and down he goes. Well, that's the story of the shell diver and his tragedy. Evans had a number of stories, and some of them were fairly macabre like this. But the idea tries to bring home the point that here the down wave is reasonable, right? But here the down wave dramatically increases. And it increases so much that if we were shell divers, we wouldn't be able to go down to the bottom, get that shell, and come back up to the surface safely. We would expire because of lack of air, because this is such a deep wave down. Okay? This is a change of behavior in the wave structure. Okay? Change of behavior. The down wave becomes larger than any of the previous down waves. And then the up waves shorten. And that means that we're going to go down. Okay? That's the shell diver's tragedy. Everybody understand that? It's a nice little way of seeing this in the market. Nice little way to understand it through a story. Okay? Any questions or comments on that? It doesn't necessarily have to be either at the end of a trend. You can see here, I mean, we certainly have, if we go up, we got that shell diver here, he drops down, gets a shell, puts it in the basket, same thing here, and here he probably dies, right? But also, look, even on this rally up here, we've got wave here coming down, picks up the shell, puts it in his basket, right? Picks up the shell, puts it in his basket. But here, look at the length here. It suddenly increases. Then the up wave decreases, right? You can take a trade here, or even better, allow it to break down and then take your trade here. But this is still the shell diver's tragedy even here. It's when the whole idea is seeing changes of behavior when the wave structure changes. That lets us know that there is a change of trend coming. All right. That's the opposite of shortening of the thrust. Now it's lengthening of opposite waves. Let's go back now to shortening of the thrust for a second and talk about it in terms of price bars. This is kind of our introduction to price bars, but it's not a significant, we're going to do much more on Saturday. We can see shortening of the thrust in the price bars, and this is a way to begin to orient to price bars. It's a useful way to orient to them, okay, to begin to get you aware of them. On a down move, successive bars make less and less downside progress, and on up moves, it's the same thing with the waves, but now we're just looking at the individual price bars. Successive bars, in other words, bars one after the other, make less and less upside progress. And we're also going to see, instead of, if we were in an uptrend, we would generally see the price bars closing on or near their highs, right? So in other words, if we're in an uptrend, the close is going to be here. Or uptrend, close is going to be here. Uptrend, close is going to be here. On or near the highs. If we were in a downtrend, close here. Downtrend, close. Downtrend, close, right? But now, when we're seeing shortening of the thrust in the price bars, closes are going to be off the extremes. They're going to be starting to come in the middle, right? Maybe even on the lows, okay? Making less and less progress. So you can see on this up wave, this I just drew here, if we drew that graphic in, and we just measure on the bars, you see what's happening? Shortening of the thrust in the price bars. And then you're also going to see, as kind of confirmation, that the closes are off the highs. So let's take a look at this. Here we have shortening of the thrust on both the downside and the upside. Let's focus on the downside first. Here we have, the waves are coming down. We've got to A, that should be B, I guess, right? B, and then C and D. Okay, so we have waves here. But look at down here. We make this progress, and then this progress, and then this progress, right? And notice the closes. We're not closing on the lows now, right? We're closing mid-range, and we're closing strong. This is shortening of the thrust in the price bars right here. Okay, everybody see that? It indicates that they're having a real hard time pushing this market down, right? Same thing up here. Shortening of the thrust in the price bars on the upside. Look at, we're trying to make progress. We make good progress up here and here, but suddenly we're not. And also the closes are negative. It's a change in behavior, right? Here, we're making good downside progress. Here, it's really hard to move. The behavior is changing in this market. Behavior is really changing. Here, easy to go up and up, right? Here, hard to move it up. Change of behavior. Okay? Any questions on that? Should be pretty straightforward. Here's a very useful way to use this. One little useful way to use this. You could just take what we did tonight with maybe another little bit of refinement and just trade what we're going through tonight, and you wouldn't need to do anything else. Let me show you something called confirmation and non-confirmation, or better, relative weakness and relative strength. Here we have SPY, which represents the market, the American market. Here is XLI. This is a sector fund, an ETF, an exchange-traded fund representing the industrial sector, one of the 8 big sectors in the S&Ps. So you can see that, here we start off here on this chart. We make a high here in the overall market. We make a high here in XLI. Very nice. We make a higher low, a higher low. Very good. We rally up, make a high. We rally up, make a high. Very nice. We make a low, higher low, higher low. Everything is in sync, right? Now look what happens. In the overall market, in the parent market, we make a new high, a higher high here. Okay? But here we don't. In the sector, we just test this high. This indicates on its own what we call comparative weakness. Comparatively, XLI is comparatively weak to SPY, right? We also see shortening of the thrust in the price bars on SPY and on XLI. So if we were inclined to go short, this is the stock we want to short, okay? Now, I'm not saying that's necessarily a great trade here, but we can use this where Wyckoff was very big on comparative strength and comparative weakness. And this is a way to use that and to combine a couple of things. So here we have a story. We have shortening of the thrust. We have comparative weakness. We have shortening of the thrust in the price bars. We also have shortening of the thrust overall here, if we look. And certainly shortening of the thrust here. And shortening the thrust in the price bars. So there's a bit of a story there as well. Okay? Notice this. We can go even further with this. We can see here we have, this is a S&P 5-minute chart. Here is yesterday's high, probably. So we have a high. We have shortening of the thrust in the price bars. Poor closes and the market starts down. Okay, we break down. I'm not even looking at volume here. We break down. We have ease of movement coming down. We rally back up to the underside where we had support. Now it's resistance. We have shortening of the thrust in the price bars and a reversal. Go short. Perfect trade. Ease of movement coming down. Choppy action coming up, shortening of the thrust in the price bars. We get that reversal right at the support level here, and we can short that. Okay, we might have shorted here earlier, and depending on where you put your stop, it might have gotten hit. But we see this again, and we just short it again, and look at that nice move down. You can draw in a trend channel here. And it would show you very nicely, as always, that we have confluence in here, and here's the place to take the trade off. Right? Simple things, very effective. And so here now, we can look at shortening of the thrust in the price bars as we come into a important level of support or resistance. We can also add to this the notion of down wave, up wave, down wave, up wave, down wave. Down waves are longer than the up wave, longer than the up wave, longer. Okay? Keeping you straight. And then the support turning into resistance, and support turning into resistance, and shortening of the thrust. A nice story against which to take a trade. Any questions on that? Okay, seeing none. If you do, just go ahead and ask, because I'll be happy to try to answer them. All right, last thing I want to talk about tonight is something called absorption. No one ever talks about this, but it is a very nice sign of strength, and it's important to be able to recognize it when you're reading a chart. We see price holding gains after an up move. And if we look over to the left-hand side of the chart, we're going to see supply there, some residual supply. And what absorption looks like, or you can sort of analogize absorption to be, is we're eating through that residual supply. Sometimes VSA talks about absorption volume. This is not what they mean. This is a pure Wyckoff term. So if anybody is thinking about this from a VSA perspective, let that go and look and see what we're talking about here. So here we know that there's some supply here, and I couldn't show it on this chart, but back over here, this market had other supply here, another high. So there's an area of supply that you can kind of look at here. You can see. So here we have a gap open, and now we rally up and it holds. And look at this right here, right in this area. We see a little supply also coming in here. Now, unlike earlier where we saw the down waves increase, we don't see that here. Okay, even though there's a gap here, the gap is not the salient thing here. The thing is that we have up wave, and the down waves are smaller. And what's most important about this chart right here is this right in here. We just go sideways in a very narrow range, eating through and absorbing whatever supply exists from back here. And I'm going to show you even better examples of this so that's clearer. But what we expect from that supply is the market to start pushing up, which it does. Okay. Now, let me take and look at this chart here. Clearly, we see supply in here. We have big volume coming down, lots of buying in here, but lots of selling as well. We come down, we make a bottom, right? And then we rally up. We get up above that old high here, and we confront this area right in here that I've outlined. The price confronts it. And how does it confront it? It just goes sideways. It's absorbing whatever residual supply exists over here. Okay? I know you tend not to be a breakout trader, but is a breakout of an absorption level a good place to enter a trade? Yeah, I do that a lot, actually. I will enter it, and I'll show you what I look for here when I do that to confirm that there's absorption. And this is actually a good chart to see it in. First of all, let me erase this so you can see. First of all, we're going sideways. But look at what happens. We're going along for, this looks like it's like early April into late May or June. So it's over a month and a half on this daily chart. That's a plus when it goes lengthy like this. But look at what happens here at the end. See how Wyckoff would say that the supports were lifting. In other words, the lows of the day were lifting. And at the same time, we're seeing volume coming in. Now, this big volume is one of these two bars here. I'm not talking about that. What I'm talking about is right at the end of the trading range, as the market is pushing up and the lows are lifting, we see that volume coming in. That means that the smarter money or whatever, the buyers are getting eager there and they're about to push it up. When I see that, I will typically just buy it at that point, where the higher volume does not push the market down. Okay? So when we look to the left, we see a supply level. The market goes sideways. What's really the confirmation is the lifting of those supports and the volume starting to pick up towards the end. Okay? And you can see that, this is classic absorption right here. absolutely classic. We rally up now, and look at how we just go sideways here. This is a little bit of a spring. This is not classic absorption, but if we look to the left, look at what we see. We see that big churning over there, a lot of supply, and we're just eating through whatever residual supply exists. So you want to see the supply area over to the left, and then we just go sideways. Another way to think about this is that the market is holding its gains. It's not reacting. Okay? It's holding gains. Here we get a reaction. Here we're just going sideways, holding our gains. Okay? A little bit of an unusual, here we have a supply area to the left, and you can see that this is just pushing right up. And we see that classic increase in volume towards the end. Typically we don't see the highs lifting like this, it's more like this, but even still it's pretty good. Pretty nice example of absorption. Holding gains there. All right, any questions on absorption? Before we end that and before we end tonight. Did I make the hour and a half? No, we're 2 hours again. It's typical. How to anticipate, how to differentiate between absorption and demand exhausted. Okay, good question. We will see demand here with ease of movement, then just going sideways. Let's go back to that first example, which is even better. We put in the higher high, there's demand here, some ease of movement coming in here, right? And then if demand was exhausted, then supply would come in and we would see the market start to fall. But we don't see that here. Demand may look exhausted because you've got shortening of the thrust up here, right? So it looks exhausted. And if we did a trend line, we would see that that trend line, it's not coming in. Okay, so that would be our first thought. We've got a trend channel. It's not making it all the way, so it's shortening of the thrust. Okay, that would be our first inclination. And there's supply over here, so that would be logical. But then the market doesn't go down. The market holds its gains, right? It's holding its gains. It's telling us that it's not going to go down. It's going to go up by doing the, by eating through that supply. And it's what you don't see it written anywhere else. But then that just kind of negates the idea of shortening of the thrust and negates the idea of demand being exhausted. It's saying that demand is really, it's just another way of going through the supply area here. Okay? And look, you extend this out and look at what we have, right? Look at what we have here. A confluence. So now, on top of absorption, isn't that nice? Isn't that lovely? Here, we may not have been able to see this, okay? We may not be able to see this. Or may not be able, sometimes absorption is hard to detect. We don't know if it's shortening of the thrust, and we stand aside. But then we have ease of movement up here, a new high, we have a good reaction, confluence back to the point of absorption, volume dries up, we've got narrow spreads here. It's a good place to take a trade, and because we know about absorption, because we know about ease of movement, because now we're in a good uptrend with higher highs and higher lows, we can take that trade. Okay? So it's another way to think about it. All right. So, here's some suggested assignments to do. And I know you're not going to get them done by Saturday, and we'll probably do a quicker session on Saturday because we won't be able to go through everybody's charts, but we'll do it on the following Wednesday. Here's some suggestions. In the markets that you trade, find shortening of the thrust in the wave structure and in the price bars. Also look for absorption and see if you can't find some shell diver tragedy setups and see what happens with those. Okay, that would be kind of like part one. Part two is combine waves and trend lines. Okay, pull these two together and identify trade locations. Don't worry about the exact spot about where to get in or what have you on the trade. Just a general location using the wave structure and the trend line, where to find trades, okay, where to identify the locations. This is important stuff. This is what you want to start to really focus in on and really learn. All the rest that we're going to do is kind of icing on the cake. If you get this stuff the first couple of weeks here, if you get this and begin to get this into your mind and get this into your idea of trading, you really have something that you can go with here. I'll show you more stuff for sure, but this is really important. Okay? All right. Any other questions here before we end tonight? This is probably pretty new for a lot of you, right? I'm hoping that you're finding it useful. Yeah, quite different from traditional technical. Yeah. Just for later, I need to understand better the difference when increasing volume on down bars are weakness and when it's strength. It has some VSA hardwired here. Yeah, okay, we'll go through that. I'll show you that. Your presentation and passion is compelling. Thanks, Kevin. Would you recommend when we begin our day with our trading, we mark up resistance and support, trend channels and waves in the overnight session? Yes, I'll show you how to do that. Especially if you're trading the S&Ps and prior day to set the stage for the current day trading. I think that's the assignment for next week. Yeah, you can do that, certainly. Absolutely. Absolutely. I'll show you a little bit about how to use tick charts here and how to think about coming in the next day, where the important levels of support and resistance are. You know, for example, today, in today's market, I don't know if you guys read my blog or not, but last night I said we should see some follow-through from yesterday's strong move up, right? We got just a very tiny amount of follow-through, and by the time we come into the market this morning, what do we see? We see that we're trading underneath yesterday's low in the overnight. Well, that throws out all of our conception about going higher, and now we're thinking about going short because it just wiped out all of yesterday's trading. Yesterday's highs and lows are key levels if you're trading the S&Ps or you're doing any kind of intraday trading in any kind of market. The yesterday's highs and lows are key levels to be aware of. Why? Because that's where supply or demand came in yesterday and stopped whatever move was happening. Yesterday's low stopped whatever down move was going on, and yesterday's high stopped whatever up move was going on. So you want to pay attention to those. The markets trade around those levels all the time. So yeah, Kevin, you want to lay out your trend channels and particularly pay attention to the most obvious things on your chart, which are going to be yesterday's highs and lows, and maybe the hourly swings or the bigger waves are going to be important too. And we'll talk more about that. And I'll show you a way. I don't know if I do it next week or the week after. It's either going to be Saturday or Saturday or Wednesday. I'll show you how to set yourself up for the following day. All right, everybody. I think that's it. Any last questions? And if not, we will see everyone on Saturday at I think we said 3 o'clock Eastern Time, 1500 hours Eastern Time. And we will see you then. All right, everybody, have a great rest of the week trading, and I'll see you Saturday. Thanks. Bye-bye now.